everybody. Welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Today, my guest is Shonda Warner with Chess Ag Partners, making a return appearance here on the show. Nice to have you back.
Thank you for having me.
So let's get right into it. Your overview about the ag markets right now. I think we had a little conversation at the Index Universe conference that was held back in December, and I think you're a little bit bearish on some of the, at least some of the grain markets.
Yeah, I think more so. I'm mixed right now.
Mixed?
I'm mixed right now. The bearish side of that is that I think by the end of 2012, there'll be lots of grain in the world if we don't have any major drought or sort of weather issues happening. And so there's going to be a lot of corn, everything, you know, we have plenty of supply, let's say.
Okay.
And I think that as well, I guess if I was pushed to place chips someplace, I guess it would be still bullish dollar. I mean, the dollar is sort of the worst, or is the best of a bad basket of currencies or countries that have problems. And so I think that we could continue to see the dollar rally in 2012.
So would that translate into?
That would translate to negative grain prices.
And negative commodity prices in general,
negative
right?
commodity prices in general. I think that, you know, people who are insiders in this area, of course, live and breathe with the notion of the correlation to the dollar, with the dollar and hard assets. But maybe people new to the sector who haven't invested in this area before aren't so knowledgeable about that correlation. So I sort of keep warning people, keep talking about that. Now, if the dollar rallies and everything else is equal, we're going to sell off here.
Yeah.
So that's sort of a bit concerning right now. I think overall, you know, the dollar and everything else, I mean, everybody's going to have to inflate, and how they do that's going to be the gazillion dollar question.
Well, they're certainly not doing it through fiscal policy, which is austerity everywhere. Right? And the monetary policy side, I mean, they're QE1, QE2, QE3, but it hasn't equated into any broad inflation at all. I mean, if anything, you can make an argument that it's deflationary. It removes a lot of interest income out of the economy.
I think that that's true on one hand, and yet on the other hand, just to kind of get, you know, kind of have that discussion. You know, I've just come back from, I'm on my way back to Mississippi from 10 days in Europe. And everywhere I go, prices are higher for things that I want. Subway ticket in London is now £4 for a single journey in the center of London. And just a couple years ago, it was £2.20. And so I think we have this secret stealth inflation thing going on as well. In many, many places, property prices have increased another 15 or 20% in the center of London. And yet there's sales in every store, 70% off. What's going on here?
Right, and you have, well, wages going down, and
wages
property
going down.
prices, at least here in the United States, still falling.
Still falling. And so I think it's true that this money is sort of being sucked up away from the middle class, and certainly away from the poor, into the banking industry just to save the banks or whatever. And the people who are sort of aware of this are afraid. And so in London, my sense was that people were putting cash anywhere they could in hard physical assets. Now, you know, that's sort of the other side of my little bearish thesis that for grains, let's say, is the fact, or farmland for that matter, and we can get into the farmland side of that. I mean, that's the ultimate, you know, I guess, value play.
Right.
If grains go up, land eventually follows. If grains go down,
is that happening now in
follows.
farmland?
Farmland had an amazing year in 2011. Scary amazing.
Price-wise,
Price-wise, yeah. Up 20, 30% or more. Wow. in many places. And I mean, it was a wow. And it's sort of scary in a way, because I think that it's gotten a little bit ahead of itself. And cash yield. So if you buy a farm and you let that farm out to a farmer, you typically might expect, I think an average personally from all the work we've done is 5%, right?
Right.
Now that's gross. You got to pay taxes and insurance and, repairs and maintenance and things out of that. But 5% is what you could expect.
Positive yield.
Positive yield, current yield. And that number in some places is down now around 2 or 3%, maybe 1% in
Really?
some places. Yeah, and it's scary because if there's any sort of shock to the system,
right.
Let's say that grains go down, there's plenty of corn, we don't have any weather issues, and everybody plants and go crazy.
Again.
Yeah, that too, right? And grain prices come down. If oil doesn't come down with it, there's going to be
margins go negative.
Yep,
your profit margin
yep, there's
goes
going to be
negative.
some problems on the farm, and guys are going to start bailing out of their $500 an acre.
Now, who's
rent.
buying this stuff? I mean, is it people in the farming industry or speculators?
I don't think it's speculators per se, really. It's farmers themselves. Excuse me. They're still a major part of the market. And then there's all sorts of quite well-to-do people, maybe not on the coast. I think it's actually beginning to happen on the coast, but certainly across the center of the United States, who look at their bank and say, 1%, I can't take it anymore, less than 1%. At least I get 1 or 2% if I go buy this farm. And they might not have experience doing that, and they might not realize there's hidden costs there. And they go out and pay a bundle for a farm, and it's happened all over the place.
But is that sustainable? I mean, it sounds like from your description of the economics of it right now, it's sustainable to a point, then it crashes right back down again.
Well, yes and no. One thing that I should say, again, I'm confused. So you're going to hear me talk both sides of this argument today because I really am at a confused spot.
I do that all the time.
I usually have really succinct opinions, and right now I'm a bit torn. But, this stuff is not levered. Don't forget that. So if people are putting real dollars, not levering at all, into a house in London or a farm in Iowa, they're not going to get squeezed out. They don't care if it drops 20 or 30%. They're holding on because they think something's going to happen in the next 2 to 3 to 5 years, which will sort of bring back their valuation, and they're happier there than with it in currency, perhaps.
Good point. I'm interested in like your kind of, I guess, when you describe your own, sort of confusion about prices, and you come from a background, the trade, in the agricultural industry, and I find that often people who come from the trade, they look at the fundamentals and they look at the current price levels, and it does not compute. Is that kind of what's going on in your head?
Yeah, that's to some extent what I feel. And at the end of the day, if we talk specifics, whenever I go out to buy a farm to put into our fund, I ask myself, we do all the due diligence, and assuming every hurdle gets jumped over, I say, what if corn goes to $4? What if beans go back to $9.50? What if wheat's at $4.50 or $5? Can I cash flow? And if I can say yes, I probably, stick my toe in the water. It might be dicey for a time. Things might back up. But I think I'm in the camp, ultimately, that something, will happen. And I'd rather have the assets.
To buy on the cheap. Now, what about recently Congress took away the long-time subsidy for ethanol, right?
Yes.
What impact do you think, if any, will that have on corn prices?
I think that will almost have no impact on corn prices, yes. Because that subsidy went to big oil. And so it was 42 cents a bushel, and it was a blender's credit to encourage big oil to blend ethanol into gasoline. And they've done it, and it makes them lots of money. And so unless you were to see oil go sort of down below $50, these
so
guys
the
are
amount
making
of subsidy is too small. There's still plenty of profit in there for them. So demand for corn, for ethanol, is going to be unfazed, basically.
I think demand for ethanol is going to be unfazed at the current price levels. And so I think that farmers really didn't benefit from that subsidy particularly anyway. Big oil did. Did they need it? Well, different people would.
Now, what about the removal of the tariffs on Brazilian ethanol?
Well, again, I personally don't think it will have a huge impact. I can't remember the percentages. I'm terrible with percentages, but a large amount of ethanol came in through protectorates, U.S. protectorates in the Caribbean into the United States anyway. I don't know whether it's 25, 30, somewhere in there percent of all ethanol in the U.S. is from Brazil anyway. So, you know, and they need their ethanol in their country. They're further along with their technology to run their vehicles.
What do you make of the explosion in ETFs? I mean, now there's ETFs in everything, every individual commodity, corn, soybeans, cotton, sugar. You know, from your perspective, what has that done to the markets?
I have friends that run ETFs, so I have to be careful
be
here.
Diplomatic
I have
here.
to be very diplomatic. I'm not a big fan of ETFs. I think that what's true is that many investors don't realize that their counterparty isn't a bank, or it isn't the physical asset itself necessarily. It's a company. And so I'm sure, I don't know when, 1 year, 5 years, 10 years, that we'll have this enormous explosion, and ETFs are going to have something to do with it. I think it increases volatility in the marketplace, because as people are buying and selling ETFs, they're buying and selling the underlying, and that's especially true in areas where there's a lot of 2x, 3x type of products. And, you know, I hate that.
Yeah,
it makes it harder for real people to use those instruments to hedge, which is really what the futures were there to begin with.
All right, so let's just wrap up with sort of your longer-term, broad outlook. Put money into hard assets, some X percentage of your portfolio, by some way, shape, or form. These trends are going to continue. That's what it sounds like.
Yeah, I think these trends are going to continue. Be really careful. Try not to overpay. Think about, you know, what you're doing and what you're paying. If you back up, make sure you're happy. Do not lever to go there. But it's probably a very good idea to have some portion of your portfolio in hard assets.
And wait for farmland to come down a little bit, right?
Well, we'll see. There's still deals out there. There's still deals out there. We're still find things that we want to put in the portfolio.
All right,
so
great. Shonda Warner, thank you very much.
Thank
That's
you.
it for now, folks. This is Mike Norman. We'll see you here next time. Bye-bye.